Oh, we're taking video now. So for the first time, we're also going to do this on video and get it to the website. And again, I want to thank all of you for tuning in. We're going to give people about another minute here. If you could, just to make it easier until we open for questions, if you could just mute your phones while I do a short presentation. You got about a minute here, and then we're going to get going.
Has joined the conference.
Stephanie
has joined the conference.
All right, again, I'm going to thank everybody for joining us on our 2020 review and 2021 outlook. We call it Perspectives. I'm here at the office. We're going to do this on video and post it to the website as well. So again, thank you for joining us. Thanks, first of all, to our clients who we appreciate the trust that you've placed with us, and we don't take that lightly. And without you, we wouldn't be here. I also want to thank our team here at Vista, Olivia, CJ, Kim. You guys are awesome. I would not want to do this without you, and well, maybe I just couldn't do this without you. So thank you guys, and thanks to our partners at Vista, Indiana, Brett, Sarah, Stacia, Matt, and the rest of the crew. We have a great team in Indiana as well. So without further ado, 2020 in hindsight perspectives. The first thing I want to comment about 2020, for many of you who heard me through the year and all of you who have experienced it, 2020 was anything but typical. The index at the end of the year read up 10%. That's the S&P 500 equal weight index. And that told very little of the story. The cap weighted index was up 16%, the Russell 2000 up 18%. We use the equal weight S&P 500 because the cap weighted index is heavily weighted to technology. Many people are familiar with the FANG stocks: Facebook, Amazon, Netflix, Google, Microsoft, Apple. Those 6 stocks on the cap weighted index represent something like 27, 28% of the
join the conference
of the index. And the other reason that we like the equal weight is I think that the techs are a bit overvalued, particularly those names I just mentioned. And I am fortunate enough to have been around long enough to experience the tech bubble of 2000.
Has joined the conference.
Olivia or CJ, when they're coming in, we're hearing everybody's name announced. Not anything to do with it. Okay. I can't mute it because it's recording. Okay, got it. So without any further ado, we're going to talk a little bit about interest rates. The pandemic of last year was a huge game changer for interest rates. In fact, back in March of this year, when the pandemic began, the Fed essentially took interest rates to zero. And we announced in the U.S. a huge stimulus of $1.6 trillion. And the Fed began pumping money into the system due to due to the COVID virus. And what the Fed told us then and was unprecedented was exactly what they intended to do with interest rates. They essentially gave us their playbook, and that was they intended to keep interest rates.
Reggie Brunner.
The current interest rate stands for the foreseeable future until inflation tops 2%. So the interest rate market, bonds rallied tremendously. Interest rates went to zero, and the pandemic began in March of last year. Gold was soared then. We saw crude oil when we had the shelter in place. We saw crude oil go to a minus $15, and I never thought I would see crude oil below the 1986 lows, which was a print of 1055, and we actually saw it below that. We saw dollar weakness through the year, which is not a bad thing for the U.S. economy. It makes our exports look more attractive overseas. And oh, by the way, there was an election last year, as some of you may have noticed. So it was an event-filled year. In fact, just on a tactical basis, we were up early in the year between 7 and 8%, then we dropped 35%, then we rallied 35%. In the middle of that rally, we had a 9% correction, a 9% rally, another 9% correction, another 9% rallied, and then we finished the year plus 10%. In other words, the market moved around 130% to get to that plus 10% on the year. There's no time in history when we've seen that kind of volatility in the stock market. The upside of this is that the stance the Fed took and the Secretary of Treasury adding liquidity to the system kept a severe recession from becoming something more. And their actions back in March actually marked the low for the market, and the market began climbing its way back and finally to exceed the all-time highs. So quite an eventful year. We did a mid-year update, and I was looking into the fall and saying it was going to continue to be bumpy. We saw two between 8 and 9% pullbacks, one in September and one in October. And then we had the election coming up in early November. Our seasonal entry that most of you know about proved to be a great entry for the market. I was concerned about it with the election coming. But as it turns out that the market continued to rally post-election and really has rallied all the way through today on the 4th of February in 2021. The unprecedented thing we saw last year was not just our Fed stimulus, but global stimulus of over $6 trillion around the globe. And essentially what that has done is it has inflated the economies so that they weathered this storm of the pandemic. Now, I said weathered very poignantly. I believe that the pandemic is on the downhill side as we continue vaccinations and get herd immunity. I think by late in the second quarter, the pandemic isn't going to be a distant thought, but it's going to be really on the way out. Another interesting thing that happened in all of this that is sort of unprecedented. The Fed has given us the playbook for the U.S. economy. They have said that they're going to keep interest rates near zero on the short end through the end of 21 and into 22. and they really don't see rates going up until 23. Now, the reason that that's so important is when you put that much liquidity into a global economy, we should see expansion. And I want to talk a little bit about the market, what we're going to expect this year. This year is the first year of a presidential cycle, a new administration in the White House. That has typically been a tough year for the market. You could read that to be up single digits, maybe mid to upper single digits, but I think that a lot of the recovery has been discounted into the market. So I wouldn't be shocked to see some short-term volatility in the market. Again, when the Fed gives us the playbook, though, on these declines, we want to be buyers because we know that this stimulus and the longer term outlook for the market is good. If you think back to the last recession where unemployment peaked a little over 10%, we saw unemployment at 16% in this recession. And by the way, in my view, the recession is ending now. It may end up technically ending at the end of the first quarter or even in the second quarter of the year, but the recession is pretty much over as we start seeing, again, the vaccinations being distributed over 1 million a day at this point, way higher than the new case count, which is yesterday was 123,000 or something of that nature. So we want to be aware that the Fed's given us their playbook, and so the key to recessions ending is money being easy to find, and then the next recession will come when credit is tight. So that is the reason that recessions happen is credit is tight and money needed for expansion is harder to find, and thus we go into a recession. That is not the case we have here today. Again, I keep saying the Fed's given us their playbook. I'm going to continue on that mantra. I don't think we're going to see much change in interest rates on the short term. Longer rates go up, and for those in the business like me, what we're looking at is a re-steepening of the yield curve, which means the difference between short-term rates and long-term rates is going to expand. And that is a very healthy sign after a recession. It means there's demand for credit is available. And so we're already seeing that happen. That spread got down in the 20 basis points. We're back about 110, 115, something like that in the spread. So for this year, interest rates stay pretty flat. We'll see the long end come up a little bit in our bond strategies. That'll help us with some yields in the intermediate term. I mentioned this, but again, I think that somewhere in the mid single digits to upper single digits is the return we'll see by the end of the year. As most of you know, there's more stimulus coming. Currently proposed in the House and the Senate, 1.9 trillion proposed. The Republicans have countered with 600 billion. We're going to get more stimulus. A year ago, I said that I thought rates would eventually get to 57, or actually, one a year ago was last summer. And I told a couple clients this, if I were a baseball player, I would be dropping the bat and trotting around the bases. My long-term projections for crude oil are considerably higher than it is now, which I'm not even going to give you a number because it kind of makes it not seem real. And I want to talk a little bit about the strategies we run. We here at Vista have 4 growth strategies that we run on a client-wide basis. The 2 stock strategies, the investing for growth strategy that last year was up 1.79, and the GRIN strategy, which was up 402. They both trailed the S&P last year. It was the first time we underperformed in 9 years. I kind of feel like Tom Brady. We finally underperformed last year and probably got traded by a few people, and we anticipate being back in the Super Bowl. The last time we underperformed was 2011, so we had 8 straight years of our growth strategy outperforming. The growth income strategy is kind of designed to be a little bit less return, less risk. So we kind of anticipate that it's not going to outperform the S&P. So let's talk about what really drives those strategies. Is we like to monitor earnings estimate revisions with analysts. The last 3 quarters, we have seen U.S. companies exceed analyst expectations dramatically, both on earnings and on revenue. And had you told me that back in March of this year, I would not have believed it. But U.S. corporations have been incredibly good at adapting to a very difficult situation. And so we're very impressed with U.S. corporations as a whole. We have more stocks eligible in our strategies than normal. That means it's a very broad recovery. Vista is earnings driven, so we'll continue to do that. We have seen this quarter be a little hard, even on those companies beating earnings estimates. This quarter there is, and this quarter being the reporting for the 4th quarter of last year. Right now, about 75% done. Earnings have surpassed estimates by 17.3% in aggregate, with 80% of companies beating their projections. And we're actually going to see revenue growth year over year for most of the S&P 500 companies. They're going to see earnings growth and earnings per share growth as well. So I'm just amazed at how well companies have adapted. I think there's some pent-up demand, though, because travel's not back to where it was, and spending is not quite where it was. But that's going to come over time. In the last recession, one of the pieces that I talked about a lot is that once unemployment peaks and starts to go down, when we get to full employment is when we're at the most risk for a recession. So we're quite a ways from that right now at about 6.7% unemployment. So there's that. And so I still think that pullbacks of the more significant nature, more in the 7 to 9% range, are places that we can add to positions. I think earnings comparisons are going to get harder in the second half of the year because of how well U.S. companies have done this year. But I do think that we have one more quarter where we're going to look pretty strong versus last year's numbers, which should be this first quarter, because the pandemic didn't begin until in March, and so that hurt last year's first quarter numbers. So this year should be a pretty good first quarter. The keynotes going forward that we're talking with clients about is we want to pay attention to the Fed as long as they're not raising rates I think that we're in a healthy environment for the growth investing. We do think the rates are going to get increased probably mid to late 22 or early 2023. And with that, I'm going to open it up to questions. And if you will, if you'll say your name and then ask the question, I'll try to